Hello and welcome. Thank you for joining us for this live webinar. I'm Nicole Aubrey, the Head of Distribution at Associate Global Partners. Today, we have the pleasure of speaking to Ryan Quinn, Client Portfolio Manager at WCM Investment Management, to discuss the WCM Quality Global Growth Equity Strategy. But before we begin, some brief housekeeping and a message from our compliance team. This webinar is for educational purposes only and of a general nature. It does not constitute personal advice. It must not be acted or relied upon. This webinar is not an offer, recommendation, or a solicitation. If you'd like to invest in the WCM Quality Global Growth Strategy, which we'll be talking about today, there are a few ways to do so. The first is the listed investment company, ASX code WQG. The second is the actively managed ETF, ASX code WCMQ. These can both be purchased via the ASX or by talking to your advisor. Alternatively, there's also an unlisted fund, and then the instructions for investing in this can be found on our website. Now, enough of me. Ryan, thanks so much for your time.
Hey, Nicole, good to be here.
So let's get right into it. Some of the audience might be aware, but for the newer audience members today, can you give us a bit of a run through of WCM Investment Management and what sets you apart as a business?
Sure, my pleasure, and thank you everyone for taking the time. I appreciate you being here. WCM is a $120 billion US money manager based in Laguna Beach, California. We specialize in investing in global equities. They're typically defined as growth companies, and we have a quality bias. Our portfolios are built with a level of conviction, so typically 35 to 40 stocks. And we hold ourselves accountable for finding the best ideas in the world and creating a portfolio that has a return stream that tends to protect capital in negative markets and outpace the market in positive markets. None of that really sounds very different than many other money managers. So specifically what makes WCM different is the way we approach competitive advantages. We take a page out of Warren Buffett's playbook, looking at a business as an asset that's protected by an economic moat. But in our history, we've recognized that economic moats aren't enough. No one does a Yahoo search anymore. No one has a Nokia in their pocket anymore. These were at one time wide moat businesses that get competed away. So the way we frame it is that we want to own businesses that have a moat that is expanding, or said a different way, their competitive advantage is growing. And so for us to get excited about an opportunity, we have to find a business that is growing in a durable fashion and be able to point to the underlying drivers of that growth. One thing I didn't mention is we take a long-term time horizon with our investments. We won't be trading in and out of things around earnings announcements, macroeconomic issues, or geopolitical events. We tend to take a very long-term view. So we look for businesses that have a durable tailwind and a runway of economic growth. That's the fundamental side of our business. Our firm has grown fantastically in the last 25 years, partially due to the investment talent we have internally here at the firm, but also partially because we have focused on our own corporate culture. We have three core values at WCM: fun, gratitude, and serve others. We feel like those core values animate our behaviors on a daily basis. So over a decade ago, we decided to say, could we turn this culture-focused lens onto the businesses where we're investing and potentially get an opportunity to make better business decisions, fundamental decisions, following this qualitative effort. And so we quickly recognized we needed a framework. And so the framework with which we came down to utilizing some of our friends in academia was a three-legged stool. The first leg is that the culture must be aligned with the competitive advantage. Corporate culture defines employee behavior. Employee behavior is going to define business outcomes. The second is strength. It's not enough to have the CEO or CFO be the only one that understands the culture. Everyone at the firm has to understand what is sacred at that business and what is forbidden. The last piece is adaptability, and this goes back to some of our examples of wide moat businesses that have disappeared. And if a culture cannot adapt to external pressures, or said a different way, competitors entering the marketplace, or internal pressures growing, employee count doubling or moving into different markets, then that culture won't be enough to carry the competitive advantage of the business. So when we find businesses, we can make the case that the competitive advantage is expanding, identify the drivers of that competitive advantage and a long runway of opportunity, supported by a well-aligned, strong, and adaptable culture. Those are businesses we get excited about and put in the portfolio.
Fantastic. Thanks, Ryan. Now, I know there's a lot going on in 2026, but given we're just still at the beginning of the year, let's have a bit of a recap of 2025. What are your observations on what drove markets back in 2025?
Gosh, it always amazes me how much gets packed into any individual year. 2025, if we, rewind back to the beginning of the year, the entire story was tariffs. Tariffs are on, they're off. They're on this country, not that country. Just kidding. They're on that country, not this country. And so it really created a lot of uncertainty in the markets. We entered last year with a significant valuation dispersion between U.S. businesses and businesses outside of the U.S. In some cases, 2 standard deviations away from the long-term average. We saw that reverse a little bit in 2025, where the S&P 500 underperformed the ex-US indices. When you look under the hood, you can see that there were some specific characteristics of that outperformance. If you look at the MSCI All Country World Index ex-US value, that index was up 41% last year. The MSCI ex-US Growth Index was up 26%. So that 15% differential was quite wide and significantly wide historically compared to these 2 indices. So we, being growth oriented investors, did have a headwind as many value oriented segments did outperform. Specifically, if you look at the European Bank Index, that was up 75% last year. That's a extremely unusual move for that index historically. We saw a weak U.S. dollar throughout the year that impacted U.S. businesses as well as non-U.S. businesses. The U.S. dollar broadly declined about 9% across the year. And then we saw some of the themes that we really like in the industry do quite well, but also take a bit of a breather towards the end of the year. European Defense Index, as an example, was up about 90% through the third quarter, and then retrenched about 10% in the fourth quarter. So we saw a number of interesting things pushing markets last year, some of which we had positive exposure to, some of which we had zero exposure to. And, it just creates another year where, if you made a prediction on January 1, probably none of what I just fired off would have been on the list of things I would have predicted.
Excellent. Thank you. So the weakness of the US dollar and outperformance of international markets relative to the US are 2 factors that have been front of mind with investors this year. What are your thoughts here?
Yeah, I think the rebound in international markets versus the U.S. was probably due. It's rare anything gets to 2 standard deviations away from an average that doesn't revert back to the mean at some point. Now, when we look at what was driving European indices specifically to come back to performance with some pretty significant structural changes in the area. One of which was Germany announcing a 500 billion euro infrastructure spending bill. That was a unique change that was somewhat outside of their typical character. NATO nations announced they would be raising their defense spending from 1 to 2% of GDP up to 4 to 5% of GDP. These are very large structural changes that could have echoing effects amongst a number of different industries. Of course, there were things that were driving the technology world, and then the weak dollar appears to be a bit of a political posture for the current U.S. government, allowing the dollar weakness to really slow the growth of some of the domestic businesses and give the chance for non-dollar denominated businesses to get a foothold and really outperform. So it was just some factors that we feel like were either due or maybe somewhat short to medium term in nature.
Can you take us through the major changes to the portfolio in 2025?
Yeah, so our portfolio rarely has major changes. We tend to have around 30% turnover per year, and about half of it is adding and trimming. We will have elevated activity when volatility spikes. You look at years like 2022, quite a bit of the portfolio turned over in that year. In parts of early 2020, when COVID was really ravaging the world, we did see opportunities. And when we get that period of volatility, or we do have the opportunity to upgrade the portfolio, we will take advantage of that. So on the sort of portfolio management side of things, we trimmed from areas like AppLovin 4 times last year, once each quarter, just kind of managing the position size as it gave us strong returns. We trimmed from our aerospace and defense holdings, again, on the back of some strength in the first half of the year. And then there were some stock-specific moves that happened that we were just excited to sort of reallocate capital. Most of that was on sort of first half strength. And then, in any given period, there might be some laggards that we identify as sources of funds during the year. So companies like Freshpet, Pooge, the fragrance maker, and United Healthcare were also sold during the year.
There are a couple of stock additions to the portfolio in December 25, Cardinal Health, Medline, and Welltower. Can you talk us through those stocks and how they align with WCM's unique investment process?
Sure. So broadly, you could call them all healthcare companies in a way. The healthcare sector has been one that has been fairly hated coming since 2023. This is a sector we've identified as one that had a COVID hangover. As you can imagine, all areas of healthcare experienced a spike in demand through COVID. And so that was warranted kind of in the couple of years afterwards. But in the most recent few years, we've seen a real hangover in those stocks, and they've really underperformed. Kind of, I guess, speaking out of the other side of my mouth, that's an area we'll look at very aggressively because we believe in the healthcare sector. There are businesses in there. So we want to be ready to purchase these businesses when they do kind of right the ship. So getting exposure to healthcare services was something that attracted us at the end of last year. These companies have positive mode trajectories and extremely strong competitive positioning. Couple that with sort of the age-old theme of aging population. But there's a real supply-demand characteristic to each of the holdings. A fact that we find very interesting is that by 2030, all baby boomers will be over 65, and by 2034, older adults will outnumber children. So looking at that, Cardinal Health is a great example to add to the portfolio. It's a top U.S. healthcare distributor and service provider. They deliver pharmaceuticals, medical products, and specialty care services to hospitals, pharmacies, and provider networks. This business obviously is going to benefit from aging population, but there's also a rise of specialty drugs in the marketplace, consolidation in pharmaceutical distribution, and also a move towards home-based care. The management team is doing some productive things that got us excited about adding the holding to the portfolio, including moving away from low-margin branded distribution and focusing more on specialty pharmacy services and new areas like gastroenterology, urology, and oncology. So all of that together made that an attractive addition. Medline is a business that makes and supplies medical surgical products to hospitals and healthcare facilities. They offer both their own brands as well as third-party products. This is another industry that will be growing as the population ages. And Medline really stands out because of its size, its private label offerings, and its strong logistics capabilities. They've got 69 distribution centers, 43,000 employees. And the company can really deliver quickly with very high fill rates that benefit from strong purchasing power. And then the last one is Welltower, which is the largest owner of senior housing real estate in the United States. If you think about this business in 2020, it was sort of the worst business to be in during COVID. Well, no more supply came online, and yet we continue to age. So the demand, as you can imagine, is surging while supply sort of stays put. And some of these facilities are really top-notch. and Welltower has about 1,100 private pay facilities in the country. So strong dynamics for that business and a improving industry that is being more and more well run.
Fantastic. They sound like some good additions. So we talked a little bit about some of the positions that were reduced during the year last year. Was there any particular themes that were reduced in the December quarter and what led to the team making those decisions?
There wasn't really a real overarching shift. I think that what happens with our portfolio is over time, you notice something will become de-emphasized while others move forward, and so there isn't a real characteristic to where capital was taken from across the year. There were a couple underperforming stocks, and that is pretty typical. Really, trimming from a lot of our winners is where we were able to raise capital for new opportunities, which is kind of the most fun way to manage the portfolio, because you're just taking house money off of a certain winner and establishing a new opportunity, as we did in the fourth quarter.
Amazing. So for a few years now, AppLovin, which you referenced earlier, has been a significant holding. Despite the current volatility, it's still up over 50% year on year and about 700% give or take since listed. They're massive numbers. But from a WCM perspective, what made it so unique in the first place?
Yeah, the business has done an excellent job adapting in the marketplace. The industry of helping advertisers meet developers so that they could sell advertising of gaming within games was a business that was pretty good until Apple changed their iOS process, which would limit the amount of information that users would be able that the merchants or the game developers could then learn from the users of those existing games. So it was really pretty significantly impacted by that change. However, AppLovin adapted to those changes and built their own internal AI system called Axon, which is meant to really streamline the ability for these developers to advertise within games. What we have been very excited about is that's an area that the game developers have been looking for alternatives to Meta in order to spend their advertising dollars, given that AppLovin has the ability to share a lot of data with their end customer, is extremely attractive to them. And AppLovin no longer has direct exposure to the mobile game development or publishing industry, so it's really become a pure play advertising technology company focused on performance-driven user acquisition. They in the fourth quarter of last year extended that out to e-commerce. So no longer are they just helping games advertise within games on our handsets. They are selectively adding e-commerce businesses to these handsets, to these games, such that it creates a captive audience that can then be custom tailored. The marketing can be customized and tailored to that end user. So it's a business that is playing in a unique space. Gaming on our handsets is something that is going to be around for quite some time. And the attractiveness of those advertisers to be able to be on that platform is something that really no other competitor has to offer in the space.
You mentioned what some might refer to as the magic word, AI. Let's talk about it. So over the last few years, the WCM team have started to use AI. Can you tell us how you're using this in your day-to-day?
Absolutely. We're very excited about artificial intelligence as investors. We have quite a bit of number of holdings that are either in the portfolio because of the way they embrace AI or because they enable the growth and development of artificial intelligence. We aspire to leverage artificial intelligence internally to help direct our limited human time and attention towards the companies with the highest return on our time. But we've taken it a step further. We've developed our own internal artificial intelligence that we've named Sherpa. And Sherpa is our proprietary AI model, which is designed to identify evidence, both positive and negative, as they relate to moat trajectories for specific companies. So we supply a model with our moat trajectory framework and years of expert network transcripts, broker research, financial data, earnings transcripts, news articles, and our general business work. And the model will look at the most recent period, which we define as sort of 6 months, and then we compare that to a prior period, which is the prior 18 months. And the model is able to bring out findings for us, both positive and negative, around our remote trajectory characteristics, and really specify whether each piece of evidence is either new, unchanged, or strengthening, along with the model's confidence level in each of those statements. This is taking a decent amount of time and effort for us, but we've already found it to be incredibly useful as a quick way to check in on holdings as things change in the marketplace. One of the most exciting things about it is that it's really available to all of us internally. We've written over 30,000 lines of code to develop this AI, and the prompt that it uses going through our remote trajectory work is somewhere around 12 to 15 pages long. So it's something we think is a unique competitive advantage to us. It's another example of WCM being very willing to embrace change, new ideas, and try to implement them to provide a better outcome for our investors.
Excellent. Thank you. It's so exciting to hear how AI is being used in everyone's day-to-day. Now, we have had a lot of commentary when we're talking about AI about a potential bubble and maybe it's going to burst. What are your views on this, and what exposure does the portfolio have to these themes currently?
Yeah, a bubble is something. It kind of feels like clickbait in a way. It feels like ways for viewers to get lured into a story. It reminds some of us that are old enough to remember the dot-com bubble, which burst. And so certainly anything that comes with a lot of energy or excitement will eventually be called a bubble. And in our case, artificial intelligence is a real industry and worldwide changing evolution. It's something that is supported and driven by businesses that are long-standing businesses with very identifiable revenues. You may recall that in the dot-com bubble, none of those companies were making money, yet their stock prices would be going through the roof. And really, they got exposed when they had zero earnings, and in fact, were just destroying capital quarter after quarter. And so there's not an investable case there. As it relates to artificial intelligence, you look at the hardware we have exposure to. Western Digital makes hard disk drives. NVIDIA makes leading edge artificial intelligence chips. Corning makes the fiber optic cables that allow the data to travel through between data centers and their sources. Certainly, artificial intelligence has been a very broad and rising tide. I mean, I actually heard someone say that John Deere is now an artificial intelligence name. I mean, they make tractors and things to plow dirt, but because they make these generators that could help potentially cool some of these data centers, it's an AI play now. So, the stories like that, we don't tend to put too much credence in, or that it might create a pop for that company. But really, where we want to invest are in the plumbing of artificial intelligence, and just try to make sure that our exposure is very balanced across the types of names that we like, in a broad set of business categories. So, is it a bubble? Is it not? I have no opinion. But does it feel like it's been a rising tide that's lifted a lot of stocks? Absolutely. But in any given case, our job is to pick winners when in an environment of winners and losers. And so whether it's a bubble or not, will it burst or not, doesn't matter to us. We just have to make the case that the companies we own have a visible, durable runway of opportunity in front of them.
Yeah, and that's a really important message. So if we just put AI aside for one final question in our last couple of minutes, now that we're in 2026, what are one or two brief themes that you think will be significant on global markets for WCM this year?
Yeah, I mean, I think we still have a ton of conviction in the themes we've been exposed in for the most recent quarters. I mean, when you look at aerospace and defense, aerospace continues to have a backlog of orders as it relates to engines that are going under the wings of the airplanes that are flying around. It is a COVID loser, right? We stopped traveling in 2020. That means the airline industry stopped buying engines and planes. Well, they're trying to catch back up now, so that leads to a huge backlog. owning businesses like GE Aerospace and Rolls-Royce gives us exposure to the two companies that have exposure to the narrow body planes in GE Aerospace and the wide body planes in Rolls-Royce. These are businesses that sell their engines, but then also will have maintenance contracts that extend for multiple years beyond. So we feel very good about the durability of that play there. Defense, in the fourth quarter, we saw defense names take a breather to some degree, somewhat in relation, I believe, to the fact that there were discussions around ceasefire between Ukraine and Russia. It's not our opinion that a ceasefire in Ukraine and Russia stops this theme. If NATO nations are committed to restocking their defense, stockpiles, it takes time. So businesses like Saab and BAE can really also point to significant backlog of investments. We think that healthcare will continue to be a volatile yet opportunistic place to go. We're looking very hard at the pharmaceuticals industry right now. But again, we've sort of dipped our toe back in with these healthcare services names. And then AI just generally will be a theme throughout the portfolio, whether it's through Taiwan Semiconductor as the fabrication facility, or it's Western Digital making hard drive systems. There's a whole ecosystem of businesses that are going to benefit from these from this bigger trend. And then of course there'll be individual stock selection throughout the portfolio that we get excited about, whether it's Tencent in Asia, our old friend Amazon here in the US, C Limited as a e-commerce play, Nintendo with their Switch 2 product cycle that's going on now. So there's a handful of things we're very excited about on a one-off basis, but the things I initially spoke about would be the most thematic that we're excited about over time.
Wonderful. Thank you so much for your time, Ryan. It's been a very informative session and we've got through lots of questions. And thank you so much for everyone who joined us today. If you asked a question that we didn't get to, then a member of our team will follow up directly after this session. If you have any questions about the strategy, please contact us by calling 1300 052 054 or emailing us at invest@associateglobal.com. Thanks so much, everyone. Have a wonderful day.